Welcome to the Finance Wisdom Summaries.
The Zurich Axioms offer a philosophy for risk-taking and wealth creation, challenging conventional wisdom about finance and life. Based on the insights of Swiss speculators, the book argues that true wealth comes not from avoiding risk, but from understanding and managing it. It emphasizes quick reactions, emotional control, and a realistic view of the unpredictable nature of markets and life. The core message is to embrace uncertainty, act decisively, and focus on opportunities rather than illusions of safety or predictability, ultimately fostering an adventurous and profitable approach to both money and living.
Chapter 1. Introduction. What the axioms are and how they came to be. Switzerland, despite its lack of natural resources, is among the most affluent nations due to its people being clever investors and speculators. The book is for those who enjoy taking reasonable risks, as the Zurich Axioms are all about risk and its management. The axioms apply to any situation where money is put at risk to gain more money, from stock markets to daily business. Life itself is a gamble, and while most people avoid risk, the Swiss embrace it to make gains beyond being a face in the crowd. The Zurich Axioms are 12 profound rules of risk-taking, developed by a group of Swiss speculators, including the author's father. The axioms contradict conventional investment advice and are guideposts for successful living, capable of making one rich. Key takeaways. Embrace calculated risk as the only true path to significant wealth, moving beyond the comfort of guaranteed but meager returns. Understand that life, and especially financial growth, inherently involves risk. The key is not avoidance, but skillful management. Reject the notion that a salary alone leads to wealth. Speculation and investment are crucial for substantial financial improvement. Practical example. Imagine you have a small sum of savings, say $5,000. Instead of leaving it in a low-interest savings account, which offers minimal risk and minimal return, you decide to invest a portion of it in a well-researched but still risky startup company you believe in. This is about embracing the core idea that to see significant growth, you must be willing to put some capital at stake, just like the Swiss.
The first major axiom, on risk. Worry is not a sickness, but a sign of health. If you are not worried, you are not risking enough. Most people seek perfect safety with their money, like sober Sylvia, but this leads to minimal gains that barely keep pace with inflation. Mad Mary chose to take risks and, despite initial losses, ultimately became rich through ventures like gold speculation. Worry is an integral part of life's grandest enjoyments and is a natural, healthy response to facing jeopardy in an adventure. Depending solely on job income will not make you rich. Significant gains require placing some material or emotional capital at risk. All investment is speculation. The only difference is whether people admit it or not. There is no truly risk-free investment. The potential gain from taking risks is much bigger than the potential loss, making the game rigged in your favor when managed with the axioms. Key takeaways. Embrace worry as a signal that you are engaged in ventures with meaningful potential for gain. Lack of worry often means stagnation. Recognize that safety in finance usually equates to low returns, which will not significantly improve your financial status. All financial endeavors beyond basic savings involve speculation. Be honest with yourself about the inherent risks and stop pretending otherwise. Practical example. You're considering investing in a new technology stock. It's not a guaranteed winner, and there's a chance you could lose money. But if you're not feeling at least a little bit of worry, it might mean the potential payoff isn't significant enough. The worry acts as a barometer for meaningful risk, urging you to consider ventures that, while having risk, also have substantial upside.
Minor Axiom 2. Resist the allure of diversification.
Diversification, while intended for safety, simultaneously reduces the hope of getting rich by spreading capital too thin across many small speculations. Its major flaws include violating the principle of meaningful stakes, causing gains and losses to cancel out, and making portfolio management overly complex and paralyzing. A diversified portfolio can lead to a 0.0 outcome, where effort yields no significant net gain. It's better to have a few well-chosen speculations that genuinely attract you, rather than diversifying for the sake of it. The adage, "Put all your eggs in one basket and then watch the basket," is a sound financial bromide, emphasizing focused attention. Key takeaways. Diversification is a strategy for preserving wealth, not generating it. If your goal is to get rich, focus your capital on a few promising opportunities. Avoid spreading your attention and capital too thinly. Concentrated bets allow for more impactful gains and better management. Be wary of conventional wisdom that pushes for excessive diversification, as it often sacrifices growth potential for a false sense of security. Practical example. Instead of dividing your $5,000 across 10 different small-cap stocks, a few mutual funds, and a bond, you decide to invest the entire $5,000 into a single stock after thorough research, or perhaps split it between two. This focused approach, while riskier if the chosen investment fails, maximizes the potential for significant gains if it succeeds and allows you to watch the basket more effectively.
The second major axiom, on greed. Always take your profit too soon. Amateurs often stay too long and lose due to greed, which is defined as excessive acquisitiveness, wanting more than expected or deserved. Conquering greed improves the chances of getting rich, as illustrated by casino manager Sherlock Feldman, who observed gamblers losing everything by chasing just a little more. Winning streaks are ephemeral and cannot be predicted. It's always better to assume they will be short and modest. Taking profit too soon means cashing out before a winning streak peaks, even if it might continue without you. Regret is a part of the game, but is outweighed by preserved gains. The analogy of climbing a mountain in the fog suggests stopping at a good height rather than risking a fall from the invisible peak. The story of Alice and Harry's real estate speculation shows how greed, wanting their house to tenfold like others, and fear of regret led them to hold on too long and lose substantial paper gains. Key takeaways. Greed is the speculator's enemy. It blinds you to when enough is enough and leads to holding on to winning positions for too long, often resulting in losses. Winning streaks are inherently unpredictable and statistically rare in their extreme forms. Always err on the side of caution and realize profits early. Accept that occasional regret over missed further gains is a small price to pay for consistent profitability and avoiding major downturns. A practical example. You bought shares of a company at $20, and they've now reached $40, doubling your money. While news reports suggest it could go higher, based on the axiom, you decide to sell 75% of your shares. You take your profit too soon by locking in a significant gain, even if the stock later climbs to $50. The risk of waiting for the absolute peak and potentially seeing it fall back down is avoided.
Minor Axiom 3. Decide in advance what gain you want from a venture, and when you get it, get out. This axiom helps answer the difficult question, what is enough, by establishing a clear finish line before starting a speculation. The psychological challenge is that as wealth grows, each new position feels like a starting position, making it hard to exit. Unlike clear endings in sports, speculative ventures often lack natural stopping points, requiring self-imposed discipline to quit. Set a specific, relatively modest goal, example, doubling money in 2 years, and commit to quitting once that goal is achieved.
Reinforce the ending feeling by planning a reward for yourself when you reach your goal, associating the profit with a tangible benefit. Investment capital should not be considered inviolable. Spend some of your winnings to enjoy the fruits of your successful speculation. Key takeaways. Predefining your profit target provides a clear exit strategy, combating greed and the illusion of endless growth. Treat speculative gains not just as capital for reinvestment, but also as money to be enjoyed, reinforcing the reward for successful exits. Overcome the psychological trap of seeing every new high as a new starting point. Set boundaries and respect them. Practical example. Before investing $1,000 in a particular cryptocurrency, you decide that if it reaches $1,500, a 50% gain, you will sell. To reinforce this, you promise yourself that with the $500 profit, you'll buy that new gaming console you've been wanting. When the cryptocurrency hits $1,500, you sell and celebrate your planned ending rather than holding on and risking a decline.
The third major axiom, on hope. When the ship starts to sink, don't pray, jump. Roughly half of speculative ventures will turn sour, and knowing how to exit a bad situation is crucial for success, distinguishing professionals from amateurs. This axiom advocates cutting losses early, typically by selling when a price has retreated 10 to 20% from its highest point, regardless of whether it's a gain or loss. Obstacles to implementing this include the fear of regret, the venture might turn around, unwillingness to abandon part of an investment, the pain of realized loss, and the difficulty of admitting one was wrong. Getting stuck in a losing venture ties up capital that could be used for more promising opportunities. Refusing to admit a mistake, and thus refusing to sell a losing position, is the wrongest response of them all, hindering future financial progress. Key takeaways. Accept that losses are inevitable in speculation. The skill lies in making them small and quick. Overcome the emotional barriers of regret and ego when a venture sours. Decisive action is paramount. Free up trapped capital from losing positions to pursue new, potentially more fruitful opportunities. Practical example. You buy shares of a company at $50. The price drops to $42.50, a 15% loss. Despite hoping it will recover, you recall the third axiom. You sell the shares, accepting the small loss. This frees up your capital to invest in a different opportunity that emerges, rather than holding on to a stagnant or further declining asset.
Minor axiom 4. Accept small losses cheerfully as a fact of life. Expect to experience several while awaiting a large gain. Small losses should be accepted, if not welcomed, as they protect against larger ones and are part of the cost of speculation. Habitually cutting losses early prevents being caught in market crashes or prolonged slumps. Waiting for sagging ventures to improve is a path to disappointment and remaining unrich. Stop-loss orders can be a tool to automate loss-taking, but they can also reduce flexibility and the development of one's own decision-making capacity. The ability to make hard decisions and follow through, even when painful, is an essential speculative technique. Condensed lessons. Frame small losses as necessary operational expenses in the pursuit of larger gains, similar to taxes or utility bills. Cultivate the discipline to exit losing positions without hesitation, recognizing that capital tied up is capital wasted. Prioritize mobility of capital over waiting for vindication. Your money should always be actively seeking the best opportunities. Practical example. You set a rule for yourself: if any stock you own drops 10% below your purchase price, you sell it immediately. You buy a stock at $100, it drops to $90, and you sell. You don't dwell on the $10 loss, but rather see it as a small, acceptable cost that prevented a potential $50 loss, and your capital is now ready for a new, potentially successful venture.
The fourth major axiom, on forecast. Human behavior cannot be predicted. Distrust anyone who claims to know the future, however dimly. Economic and market forecasts are often wrong, yet people continue to listen to prophets who claim to know the future. Prophets gain credibility by highlighting their few correct predictions while ignoring the many wrong ones. If you can't forecast right, forecast often. All money phenomena are manifestations of human behavior, which is inherently unpredictable due to countless unknowable variables. Relying on forecasts can lead to being trapped in losing propositions, as seen with long-term certificates of deposit bought based on faulty interest rate predictions. Successful speculators react to what does happen, rather than basing moves on what supposedly will happen. Condensed lessons: dismiss all financial forecasts and economic predictions as they are based on inherently unpredictable human behavior. Don't be swayed by prophets who selectively highlight past successes. Focus on the consistent reality that no one can reliably predict the future. Base your speculative decisions on real-time events and observable facts, maintaining flexibility to adapt. Practical example: instead of buying into a stock because a well-known analyst predicts it will soar in the next 6 months, a forecast, you research a company thoroughly. You decide to buy based on its current strong earnings and market position, observable facts. If the company's performance falters, you react to that new reality rather than clinging to the analyst's original, optimistic prediction.
The fifth major axiom: on patterns. Chaos is not dangerous until it begins to look orderly. The world of money is fundamentally chaotic and patternless. Perceived patterns are ephemeral and dangerous illusions. Smart people, like Professor Irving Fisher, were wiped out by believing they had found orderly patterns in the stock market. Art funds and mutual funds, managed by experts, often perform no better than random chance, demonstrating the futility of seeking formulas. Financial advisors often sell illusions of order because they are comforting and appealing, but these should be met with skepticism. Luck is the most powerful single factor in speculative success or failure. Formulas that ignore this are not to be trusted. Beware of conflicting advice from sages who claim they have found a formula. Their differing yet equally asserted methods highlight the role of chance. Key takeaways: never assume order or predictable patterns exist in financial markets or human behavior. They are fundamentally chaotic. Be deeply skeptical of anyone selling a surefire formula or system for wealth creation, as luck is the dominant factor. Your awareness of chaos and your ability to react swiftly to it are more valuable than any perceived pattern or prediction. Practical example: you notice a stock has consistently risen every Monday for the past month. The chartist's illusion might tempt you to buy heavily every Friday, expecting this pattern to continue. However, recalling this axiom, you understand that this is likely a random coincidence and not a reliable indicator. You might still trade based on other factors, but you won't fall into the trap of believing in a non-existent pattern.
Minor axiom 5. Beware the historian's trap. The historian's trap is the unwarranted belief that history repeats itself reliably enough to bet money on it. While history might repeat sometimes, it is never in a consistently predictable way for financial gain. Analysts often collect past data and wait for similar circumstances to recur, mistakenly believing they predict future outcomes. The story of the young woman who lost money in currency trading by relying on historical patterns of the lira and dollar illustrates this trap. Markets do what they do and make no predictions. Arguing with them based on past patterns is futile. Key takeaways: past performance is not indicative of future results. Never base your decisions solely on the idea that historical events will repeat themselves. Resist the human tendency to find order and causation in random historical coincidences. Focus on current market realities rather than historical analogs when making speculative moves. Practical example: you notice that every time the national interest rate has dropped by 0.5% in the past, the real estate market has boomed 6 months later. You resist the urge to buy property immediately, understanding that while a correlation existed in the past, it doesn't guarantee future causation. You'll assess the current real estate market's health and other relevant factors rather than blindly following a historical trend.
Minor axiom 6. Beware the chartist's illusion. Charts can be useful for visualizing data, but dangerous if they make disorderly numbers appear solid and predictable. Chartists believe past price movements, jiggles and wiggles, can predict future prices, but the stock market has no reliable patterns and rarely repeats itself. Chart lines can be manipulated, example by compressing time, omitting bad years, to create a false impression of consistent upward trends. The danger is not just being conned by others, but also deluding oneself into seeing orderly trends where chaos reigns. Never bet on a line that looks as though it will go up and up forever. Point 1. Treat charts with extreme skepticism, recognizing their inherent ability to create an illusion of order from chaos. Point 2. Focus on the underlying numbers and fundamental reasons, rather than being mesmerized by visual trends. Point 3. Understand that stock prices and other market movements are not governed by neat, repeatable patterns. Practical example. You're looking at a graph of a company's stock price that shows a steady upward climb over several years. Instead of assuming this trend will continue indefinitely, you delve into the company's financial reports, recent news, and industry outlook. You identify whether the upward line is supported by solid current fundamentals, or if it's merely a visual artifact of past, potentially random, good performance.
Minor Axiom 7. Beware the correlation and causality delusions. The human mind tends to invent cause and effect links where none exist, especially when events occur in close proximity. This delusion makes people vulnerable by creating a false sense of understanding and control in chaotic situations. The Republican first-year jinx and Super Bowl omen are examples of observed correlations that are likely due to chance, not causation. Unless a cause can be actually observed operating, all causal hypotheses should be regarded with extreme skepticism. Imagining causes where none exist can lead to flawed decision-making and financial grief. Key takeaways. Resist the psychological urge to create causal links between unrelated or randomly correlated events. Assume observed coincidences are just that, coincidences, unless there is verifiable direct evidence of causation. Maintain a clear-eyed view of chaos and avoid letting a fabricated sense of order lead you into bad bets. Practical example. You notice that every time you wear your lucky socks, you have a profitable trading day. The causality delusion might lead you to believe the socks are the reason for your success. However, recognizing this axiom, you understand that this is a correlation born of chance, and the socks have no actual impact on market outcomes. You continue to wear them if it's fun, but you won't base your trading decisions on them.
Minor Axiom 8. Beware the gambler's fallacy. The gambler's fallacy is the illusion that one is hot or experiencing a run of luck that will influence random events in their favor. This fallacy encourages overconfidence and reduced prudence in betting, leading to losses. Winning streaks happen by chance and are unpredictable in their start or duration. They don't indicate a temporary state of invincibility. The stories of Charles Wells and Carolyn Otero, who broke the bank at Monte Carlo, illustrate astounding winning streaks, but their later lives show they were not invincible. This fallacy often leads speculators to not quit while they are ahead, resulting in losing all gains. Key takeaways. Never confuse past good fortune with a personal hot streak or invincibility. Winning runs are random and fleeting. Avoid increasing bets or altering your strategy based on the false belief that you're on a lucky day. Discipline yourself to cash out during winning streaks rather than letting the intoxicating feeling of being hot lead to eventual losses. Practical example. You've had a few successful trades in a row. The gambler's fallacy might make you feel like you can't lose and tempt you to make a much larger, less researched trade.
Instead, you stick to your established risk management and profit-taking rules, recognizing that your recent success is due to a combination of skill and chance, not a temporary state of being invincible.
The sixth major axiom, on mobility. Avoid putting down roots, they impede motion. Roots refer not just to physical location, but to a state of mind that hinders quick, decisive action in financial affairs. Minor axiom 9, do not become trapped in a souring venture because of sentiments like loyalty and nostalgia. The New Jersey couple who wouldn't sell their declining house due to emotional attachment and perceived disloyalty illustrate this trap. Similarly, an engineer held on to worthless company stock due to loyalty, even knowing its bleak prospects. Never get attached to physical things or companies in which your capital is invested. Attachments decrease mobility. Minor axiom 10, never hesitate to abandon a venture if something more attractive comes into view. This applies to situations where a speculation turns into a hobby, e.g., collecting art for investment but becoming too attached to sell. It also applies to waiting for a payoff from a stagnant investment when better opportunities arise elsewhere. The decision to switch investments should be based solely on which offers the best promise for a speedy payoff, disregarding sunk costs or potential regret. Key takeaways. Maintain emotional detachment from your investments. Sentimentality, loyalty, nostalgia can lead to holding on to losing or stagnant positions. Prioritize fluidity of capital. Always be ready to move your money from one venture to another if a more promising opportunity arises or if the current one sours. Your money's purpose is to grow. It doesn't owe you anything, and you don't owe it your perseverance if it's not performing. Practical example. You own shares in a tech company that you've been loyal to because you've used their products for years. The company's performance has been stagnant, and you've identified a new, innovative biotech company that shows strong growth potential. Despite your loyalty to the first company, you sell your shares and reinvest in the biotech firm, demonstrating mobility and an unrooted approach.
The seventh major axiom, on intuition. A hunch can be trusted if it can be explained. There are three approaches to hunches: scorn, indiscriminate trust, and discriminating use, the Zurich approach. A hunch is not mysterious, it's a conclusion based on information stored in your non-conscious mind, which you know without knowing how you know it. To trust a hunch, you must first verify if a sufficient library of data exists in your mind on that topic, e.g., extensive study, real-world experience. Hunches not based on a solid knowledge base are airy nothings akin to random brain activity and should be disregarded. Minor axiom 11, never confuse a hunch with a hope. It's easy to believe something will happen when you want it to, but this is hope, not a reliable hunch. Be highly skeptical of hunches that promise desired outcomes, but more inclined to trust intuitions pointing to outcomes you don't want. Key takeaways. Treat hunches as valuable but not infallible tools. Their reliability stems from your underlying, often unconscious knowledge. Rigorous self-assessment is key. Question if your intuition is truly informed by experience and study or merely wishful thinking. Be particularly cautious of hunches that align with your desires, as hope can easily masquerade as intuition. Practical example. You've been closely following the electric vehicle market for years, reading industry reports, analyzing company financials, and even test driving new models. One day you get a strong hunch that a specific EV startup is poised for a significant breakthrough. You critically assess this hunch by mentally reviewing all the data you've absorbed over time. If you can logically connect your hunch to specific observations and insights, even if you can't articulate every single piece of data, you might trust it. If it's just a vague good feeling, you dismiss it as mere hope.
The eighth major axiom, on religion and the occult. It is unlikely that God's plan for the universe includes making you rich.
Money and the supernatural, religion, occult beliefs, are an explosive mixture and should be kept separate in speculative activities. Relying on divine intervention or supernatural powers for wealth leads to a dangerously unworried state and often to financial loss. The story of the minister's church buying God-given land that turned out to be a swamp illustrates the pitfalls of relying on faith for financial decisions. Jesse Livermore, a famous speculator, was haunted by the idea of clairvoyance, and his reliance on supposed occult powers may have contributed to his downfall. Minor Axiom 12: if astrology worked, all astrologers would be rich. The true test of any money-making approach, including occult ones, is consistent success, not isolated lucky hits. Astrologers, tarot readers, and other occult practitioners are not, as a group, richer than anyone else, indicating their methods don't consistently work for wealth. Minor Axiom 13: a superstition need not be exercised. It can be enjoyed, provided it is kept in its place. Superstitions can be harmlessly indulged in situations impervious to rational analysis, like choosing lottery numbers. Charlie Kellner's enjoyment of using dream numbers for the lottery is an example of a superstition kept in its trivial, non-impactful place. Key takeaways: separate your spiritual or superstitious beliefs from your financial decisions. Never expect divine or mystical intervention to make you rich. Be highly skeptical of any system or person claiming supernatural insights into financial markets. Consistent success in these areas is purely a matter of luck. Enjoy harmless superstitions as personal quirks, but never let them influence your serious financial strategies. Practical example: you have a lucky charm that you carry for general good fortune. When it comes to making investment decisions, you conduct thorough research and apply the other axioms. You don't consult your charm or believe it will influence the stock market. However, if you decide to buy a lottery ticket, you might pick numbers based on a lucky sequence, understanding that this is purely for fun and has no bearing on its true probability.
The ninth major axiom, on optimism and pessimism. Optimism means expecting the best, but confidence means knowing how to handle the worst. Never make a move if you are merely optimistic. Optimism, while generally seen as positive, can be dangerous in specific money ventures as it clouds judgment. Professional gamblers are confident because they know how to handle bad outcomes, constructive pessimism, unlike amateurs who are befuddled by optimism and lose. Optimism can lead to ventures with no exits, as illustrated by Sam and Judy, who bought remote land based on optimistic promises that never materialized. Financial journalists often quote optimists more, despite their frequent inaccuracy, because their song is sweeter and appeals to human desire for good news. Confidence stems from anticipating and preparing for the worst-case scenario, not merely hoping for the best. Key takeaways: distinguish between general hope and specific financial optimism. The latter can be a significant liability. Cultivate confidence by focusing on risk management and exit strategies before entering any speculation. Be wary of the pervasive optimism in financial news and advice. It often reflects a psychological bias rather than objective reality. Practical example: you are considering investing in a new restaurant. An optimistic approach would be to only think about how popular it will be. A confident approach, as per the axiom, involves asking, what is my exit strategy if this restaurant fails? Can I sell the property? What are my legal liabilities? How much can I afford to lose if things go completely wrong? Your decision to invest is then based on your preparedness for the worst, not just hope for the best.
The 10th major axiom, on consensus. Disregard the majority opinion as it is probably wrong. René Descartes, a successful gambler-speculator, advocated disregarding majority opinion and verifying truth for oneself. In democratic societies, there's a strong tendency to accept majority opinions uncritically, which can be costly in financial matters.
The price of a speculative entity tends to fall when the majority believes it's not worth buying, and rises when they clamor for it. The paradox: the best time to buy is often when the majority says don't, and the best time to sell is when everyone is screaming, "Gimme." The auto industry's troubles in the early 1980s showed how ignoring majority pessimism about stocks like GM and Ford led to significant gains. Resisting majority pressure is difficult, as demonstrated by psychology experiments and the author's wife's experience with Ford stock. Blindly betting against the majority, contrarianism, is also a trap. Independent thought is key, whether you align or oppose the crowd. Key takeaways. Challenge consensus. What everyone knows in finance is often a pathway to average or poor results. Develop independent judgment and resist the powerful psychological urge to follow the herd, especially when prices are at extremes. Buy when assets are unpopular and cheap, and sell when they are highly desired and expensive, acting counter to widespread sentiment. Practical example. During a stock market correction, many news outlets and financial commentators are predicting a prolonged downturn, and most investors are selling. Instead of joining the panic, you independently research a few solid companies whose stock prices have fallen significantly but whose long-term fundamentals remain strong. You decide to buy, acting against the majority sentiment because your own analysis suggests these are genuine bargains.
Minor Axiom 14. Never follow speculative fads. Often, the best time to buy something is when nobody else wants it. Speculative fads, characterized by widespread public interest and high prices, are precisely when newborn speculators plunge in and buy. Brokers and service providers tend to push whatever is hot at the moment, aligning with public desire rather than objective value. When gold prices soared during economic downturns, demand peaked, making it a poor time to buy, yet many did. Independent study and thought, rather than automatic contrarianism, should guide decisions on whether to join or oppose the majority. The example of Chrysler stock illustrates that while buying unwanted assets can pay off, it's still a high-risk gamble and not an automatic strategy. Key takeaways. Avoid the temptation of popular speculative fads. High prices often indicate that the opportunity has passed. Seek value where others are not looking, but always with independent research and a clear understanding of the risks. Do not blindly follow or oppose the crowd. Let your own reasoned assessment drive your decisions. Practical example. A new type of collectible, example, a specific brand of vintage toys, becomes incredibly popular with prices skyrocketing due to media hype. Everyone you know is buying them, hoping to resell for a quick profit. Instead of joining the fad, you acknowledge the excitement but refrain from buying, understanding that the peak of popularity is often the worst time to enter.
The 11th major axiom, on stubbornness. If it doesn't pay off the first time, forget it. Perseverance, while generally lauded, can be detrimental in speculation, leading to financial doom if applied to losing ventures. The story of the woman obsessed with making money on Sears Roebuck stock, despite repeated losses, exemplifies stubbornness and chasing an investment. It is illogical to personify an investment and believe it owes you money. Such emotional responses cloud judgment. Concentrating on a single soured venture, e.g. the Sears chase, blinds you to other, more promising opportunities. Minor Axiom 15. Never try to save a bad investment by averaging down. Averaging down, buying more of a declining asset to reduce the average cost, is an alluring trap that fools you into thinking a bad situation is less bad, but often makes it worse. It encourages disregarding the third axiom, cut losses quickly, and prevents objective assessment of whether the investment is still fundamentally sound. Key takeaways.
Abandon ship quickly on losing ventures. Don't let stubbornness, ego, or a desire for vindication tie up your capital. Avoid the deceptive strategy of averaging down, which often means throwing good money after bad. Always choose investments based on their current merits and future promise, not on past losses or emotional attachments. Practical example. You bought shares in a company at $50 and they've dropped to $25. Your friend suggests averaging down by buying more at $25 to lower your average cost. Instead, you apply the axiom. You ask yourself if you would buy this stock at $25 today if you didn't already own it. If the answer is no, because the company's prospects have genuinely worsened, you resist the urge to average down and instead sell your original shares, accepting the loss and moving on.
The 12th major axiom, on planning. Long-range plans engender the dangerous belief that the future is under control. It is important never to take your own or other people's long-range plans seriously. Long-range plans create a false sense of control over an inherently unpredictable future, like the story of George and Martha, whose meticulous retirement plan was derailed by unforeseen economic changes and personal misfortunes. The future beyond a short time frame, for example a month, is fogged almost to opacity and entirely unknowable. Financial experts who sell long-range plans often base them on extending current trends, ignoring the certainty of unpredictable upheavals, wars, and collapses. Instead of long-range plans, maintain mobility and react to events as they unfold in the present, seizing opportunities and avoiding hazards quickly. The only necessary long-range financial plan is the intention to get rich. The how is unknowable and will emerge through dynamic adaptation. Minor Axiom 16. Shun long-term investments. Long-term investments, while seemingly safe and convenient, can lead to significant losses due to unforeseen market changes, as seen with Paula W. and her Ford stock. They cater to laziness and discourage active management and reevaluation. Always reevaluate investments frequently, for example, every 3 months, and be willing to exit if conditions change or better opportunities arise. Beware of attractive monthly investment plans or whole life insurance that root you into long-term commitments that may not serve you well in an unpredictable future. Key takeaways. Reject the illusion of control offered by long-range financial plans. The future is inherently unpredictable. Prioritize agility and adaptability in your financial strategy, reacting to present circumstances rather than rigid long-term forecasts. Avoid tying up your capital in long-term investments that limit your ability to respond to unforeseen changes and new opportunities. Practical example: instead of setting a rigid 20-year plan to save a specific amount for retirement in a particular type of asset, you adopt a flexible approach. You regularly review your investments every few months. If the market shifts dramatically or new sectors become highly promising, you adjust your portfolio to capitalize on current opportunities or mitigate emerging risks, rather than sticking to a predetermined, outdated plan.
Main idea of the book. The Zurich Axioms fundamentally shifts the paradigm of wealth creation from security to calculated risk. It asserts that significant financial gain is only achievable by embracing the inherent uncertainty of markets and human behavior. The core philosophy advocates for emotional detachment, prompt decision-making, and a critical skepticism towards conventional wisdom and forecasts. By learning to accept worry, take meaningful stakes, quickly cut losses, and resist illusions of order or fixed plans, individuals can navigate chaotic financial landscapes, turning risk into adventure, and ultimately achieving true wealth and freedom.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.